Welcome to the March 8th edition of Market Thoughts, our most interesting market thoughts of the whole month of March so far. I'm Dave with Lighthouse. Let's get into what happened. But first, commercial. What do we got to talk about this week? Coming up on Thursday, March 12th, our second in a series of banker education seminars, Markets, Margins, and Strategy Outlook. This is tailored towards bankers. If you're listening to this and you're a banker, don't miss this. But if you're listening to this and you're not a banker, but you're just interested in markets, margins, and what to do about it for 2026, you're welcome to join. Hit us up, RSVP, or we'll get you a link to participate in that. All right, looking at weekly changes, starting with May spring wheat here, you actually ended up gaining 23.5 cents on Friday. Big gainer to close up 30.25 cents on the week. This is after the gains of the prior week. That takes you to your highest level since back in July. Still not historically high, but pretty impressive run. You've now gained almost 75 cents since where you started out. This was our buy signal in early January. This was wheat's going to start moving. This was our first sell signal, one-day sell signal. Bit of a caution, but then blew right through that, coupled that with huge gains on Friday alongside the happenings in the world right now. May corn, similar thing. If we look at our weekly chart, May corn ended up gaining 12 cents to close at 460.5. Actually, your highest weekly close since all the way back in late June. If we look at daily chart and we narrow this up a bit, this right here on the 26th was our next trade segment saying corn's about to break out higher. This was your higher breakout. You're now to a critical inflection point. You're just to the top of this range that we traded in all winter. You're to the actual point where if May corn breaks out from here, you should actually start chasing down this next level, this next resistance in this 475 area. All right, if we pop over to May soybeans, here's how this looks. Ended up gaining 30 cents even on the week to close at $12 even, plus 0.75 cents. May beans did make their breakout here. This was critical inflection point. Thursday was a big day. We talked about it in commentary, talked about it in conversations, traded higher, and then obviously the huge surge on Friday. So this is your setup now on soybeans. If we look at weekly soybean chart, this move started below $11 and now you're above $11 and you're actually at $12 on the May contract. There's been several other times that soybeans started below 11 on a rally, moved above 11. There's only been twice when that happened, once in 2016, once earlier this fall, where you didn't make it all the way to $13, and usually you went well above. So soybeans are kind of in a land they don't spend a lot of time in. Once we get to this point, history says we're probably headed quite a bit higher. History says that. If we look at news, this piece of news says that too. Oil's now above $90 a barrel. It surged this week as just, it's tough to even synthesize this, and I won't attempt to try, but just to say in a sentence or two, the Iran situation is spiraling into a much bigger, more protracted conflict, and it has obviously implications for crude oil and fertilizer being affected a lot. We'll talk about that here in a second. Here's how it looks from a crude oil standpoint. This is what urea price has done just this week. Prices surged up almost 50%, 50, equivalent of if corn had rallied $2. Urea's up 50% in a week. You're back to these levels last seen during the bull market. Urea's been high relative to corn this whole stretch, but you're back to 2022 type levels. Corn is not back to 2022 prices. Here's a way to synthesize this. This is the price per bushel of corn, what's left after you pay for your urea to produce that bushel. So if you said, I'm going to go get me a bushel of corn, it's going to take me a couple pounds of urea. I got to buy those 2 pounds of urea. How much of that bushel do I have left after paying for that? You're down to some of the lowest prices ever when you look at the price of corn relative to urea. This matters, number one, because it stinks if you're a farmer and you don't have fertilizer bought. But it plays into something that we think comes next, which is you're really set up right now. Probably the biggest direct impact to grains might be that you're going to have an even bigger reduction in corn acres than the market thinks, just based off these fertilizer dynamics right now. Interesting also just to look at, we don't have a lot of great analogs on what happens to commodities when a conflict enters like this, but you can see this is comparing to the Ukraine-Russia invasion. That invasion had a lot more direct ag impact to it. That was actually, you're fighting. I mean, farmers were farming around spent mortar shells. You're in the breadbasket of the European continent, if you will, with the fighting in Ukraine and whatnot. Two major world exporters of wheat, and in the case of Ukraine, of corn also. So right in the thick of that, basically there's two takeaways. That the soybean chart doesn't show it as quite as well as I think corn shows it a little better. You had this quick spike once the invasion started. You rallied about 8% percentage wise, and then you leveled off, and it happened quick. It happened in about 10 days. So obviously it's not real useful to draw conclusions based off one incident that is kind of similar to this incident. But if we went ahead and did that anyhow, because we got to draw conclusions based off something, you could say that it would be expected that the magnitude of this event right now should rally grains somewhere in the neighborhood of not 8 to 10%, if you will, from where they started, and it should happen quick by the end of next week. File this away. If that were to be the case, you'd have soybeans, November beans. Now we're talking new crop. November beans around $12, and you'd have December corn around $5, which coincidentally enough, those are the prices we identified as upside targets for new crop corn and beans in our next trade segments from back around the first of the year. So using the 2022 conflict as an example, it would say next week should be a big week, like continued gains, and this may be where we're headed from there. Okay, what about everything else, though? There's a lot of other stuff still happening in the markets here. A lot of this generally leans bullish for grains right now. We talked about the high price of urea, less corn acres. That's already what the USDA was showing. It's believable. You get out and talk in the countryside, that feels like that's going to be the case, and this urea situation exacerbates that. Chinese corn prices moved to new contract highs again this week. They were higher all week. That continues to be something to monitor, as they very likely could be in the market for U.S. or somebody's corn. Very bullish demand situation for corn yet. U.S.-China trade talks still appear set to happen. Still no further word on if they're going to take all those extra beans, but the trade talks are still set to happen. Whole host of bullish biofuels news over the last few weeks, and starting to see some weather news that's supportive. You're seeing Brazilian soybean estimates get reduced here by problematic too wet and too dry weather at the tail end of their growing season and across their wide geography. And the second crop corn, the first 80% has been planted pretty timely, but the last 20% is going to be a struggle to get in, which is still enough to move the market. So if you look at all of that together, there's enough here underlying this that's supportive, plus strong seasonals, that as long as this war situation is expanding in intensity, grains are going to want to move higher. There's a canary here, though. There's definitely a canary in the coal mine. The chart I grabbed first that was wrong. I grabbed it wrong by not getting it. This is your May-July corn spread. So this is May's price relative to July price. May is getting cheaper relative to July. You're out to 10.5 cents carry. That carry actually widened again on Friday. And soybeans are doing something similar. Those carries they haven't widened, but they've stayed really wide. This is not what you want to see if you're expecting a healthy bull rally to continue indefinitely. This is a market saying it's great that futures are rallying, but these cash needs are having no trouble getting covered right now. There's no shortage of corn. We're not struggling to get corn and beans where they need to go. So this is really paradoxical to see corn make a 25-cent rally on a week and have your front month spread actually get wider. So this is your canary in a coal mine. This may not matter next week, but this will matter. This is why risk management remains important through all this. So what do our analytics say in amongst this? If we look at corn, you're just below a sell signal. This is neutral classifier data. Probabilities that are in the 40s and 50s, we tend to disregard. They're not significant enough to weigh in. So we're saying neutral probability. Our signals up at 70. Our market gauges are neutral. You have a strong seasonal. You have analytics on corn that support hedging. Certainly if you're behind on hedging, definitely supports catching up, but you're not screaming no holds barred sell. Your trend is higher also still on corn. Very cautiously, I think you can wait this out in the short term to try to see that $5 objective or something close to it fulfilled. When you look at the overall fundamental picture, though, we're still skeptical that corn makes it a lot beyond that, and we still expect this war news to be mostly priced in the next 7 to 10 days here as far as the impact of it, not any projection on the velocity, how high we would need to go, et cetera, but just that it would be priced in. If we look at wheat, you've got extremely bearish classifier data, not a ton of data points, but very bearish. Every one of these clusters featured substantial correction in price. This is one of the most bearish classifier setups we've had. You're above a sell signal. You don't have a bullish season on wheat. You don't have a fundamental catalyst. And your market gauges are getting quite elevated. I'm really skeptical that wheat can sustain this rally, and it feels like the only way it would was alongside continued row crop gains. Wheat's definitely, even though the prices are mediocre, when you start looking out of that carry, you're getting up close to $7 on deferred 27 months. This looks like a spot to be doing some marketing, especially on new crop wheat here, not one to sleep on. Then there's soybeans. So this classifier has kept us bullish on soybeans throughout, and it's still bullish. Not a lot of data points anymore, but 61% of the time you've had higher price. You're back above a sell signal on soybeans. You've been above it since Thursday, but classifier is still bullish. Trend is still higher. We highlighted that soybeans want to find their way above 13 once they get above 11. Most of the time that's happened. Impressive breakout on Friday. Here's where it melts down on soybeans. I think you can cautiously wait on that $12 November target, and just in general, over the next week or so, be watching how this trades alongside these news. As long as trend is up and classifier data is bullish, it makes sense to keep giving this soybean market more room to work higher. But as we've been noting for 3 weeks now, you're in a very high leverage spot on soybeans. You need to pay very close attention, and you need to start thinking about hedging strategies that would put a floor in while leaving a ceiling open, or things of that nature. So stay tuned. This next week will be a big one. I think next week's market thoughts will actually be the most interesting of the whole month of March here.